Imagine Pepe standing at the lip of a familiar cliff. The same fractal that sent it soaring in 2024 seems to be reforming. And traders are asking the same question again. Can history repeat and deliver a 3x move that would push prices back toward the 2024 highs? Right now, the on-chain and market picture is a mix of encouraging accumulation, leveraged positioning that can both ignite and cap rallies, and structural risks that could turn a promising setup into a long grinding range. The raw price and market cap context are compelling. Pepe has recently printed intraday, gains north of 10%, and is trading in the low 0.0001 to USD neighborhood, with live price feeds showing it around $0.00012 and a market cap in the roughly $4 to $5 billion area, within reach of the mid-cycle repricings Memecoins can enjoy. Those numbers matter because they put Pepe in the set of highly tradable Memecoins, where liquidity, social momentum, and derivatives flows can combine into very rapid moves. The technical narrative many chart watchers point to is a classic fractal, the pattern of accumulation. Tight consolidation, breakout, and short squeeze that unfolded late in 2024, and some analysts and outlets have explicitly flagged the resemblance between the current formation and that earlier explosive run. In plain terms, if the same supply-demand structure is present, large retail stacking buys across the lower bands, thin order books above key resistances, and a sizable short cluster sitting above the price, then the market mechanics that produced the prior 3x could repeat. Several market commentators and algorithmic analysts have observed precisely this pattern and placed higher probabilities on a replay given current order flow and sentiment readings. But charts alone do not make a narrative. On-chain signals give texture to the story. Into VBlock and other analytics point to rising accumulation from small to medium-sized holders, addresses in the $10 to $1 million. Holding bracket are growing, and the proportion of profitable holders has climbed, reducing the pool of immediate panic sellers. Dun-derived transaction stats show millions of transactions and a healthy buyer-to-seller ratio, indicating active demand rather than a thin speculative gasp. These are the sorts of on-chain footprints you want to see before extrapolating a large breakout. Expanding distribution across many small holders creates a deeper retail bid that can absorb selling and, crucially, can fuel momentum if narrative catalysts arrive. Celebrity endorsement, exchange listings, or ecosystem hacks turned into headlines. Layer on top the derivatives and liquidation map, and you get the other half of the mechanism. There is a dense cluster of leveraged positions concentrated in specific price bands. Liquidity heat maps show a max pain zone where substantial short exposure sat, and the recent overnight breakout swept through and cleared a meaningful chunk of that short book, producing a classic short squeeze dynamic. When short positions are removed en masse, price can gap and rally quickly because the mechanical buyers who close shorts add to buying pressure while fresh longs chase the move. If upward momentum continues and the next liquidity clusters above, the current price are thin. You could see a rapid leg higher as the short side is further compressed and buyers push into unguarded territory. But, and this is critical, the very same clusters create fragile pivots. If sellers reassert near the next resistance and liquidity is shallow, any attempt to retest the breakout can trigger a cascade in the other direction and leveraged long positions become the meat of the squeeze in reverse. The liquidation numbers therefore work both ways. They are the tinder for explosive rallies and the trigger points for equally explosive falls. Zooming out, the Memecoin market context amplifies the narrative. Meme cap rallies often happen in clusters. When Ethereum and larger altcoins show strength, speculative capital flows into meme assets seeking asymmetric returns. In the current environment, ETH's strength has broadly increased risk and allocation into meme assets, and PEPE'S social virality and liquidity profile make it a natural beneficiary. Historical fractals are not magic. They're the visible expression of deeper market behaviors. Low liquidity, concentrated set of market-making desks, a frothy retail base, and a set of narrative catalysts, and Pepe still checks most. of those boxes. The 3x thesis therefore becomes plausible if accumulation holds. Derivative positioning remains favorable to further squeezes. And macro liquidity conditions remain supportive, i.e., risk-on, ample liquidity, and no sudden tightening, but the downside risks deserve equal time. First, memecoins are uniquely sentiment-driven. Their price trajectories hinge more on social media narratives, influencer activity, and ephemeral catalysts than on fundamentals. The Inter-Theba block data showing rising retail accumulation is encouraging, but whales have been relatively flat, which means the deepest pockets of market moving capital haven't materially increased their exposure. When whales are passive, retail-driven rallies can stall when the narrative cools. Second, the concentration of token holdings at certain price levels, to very supply cliffs that allow for sharp breakouts, can turn into supply traps. If large holders choose to distribute into rallies, the same accumulation that appears bullish on chain can be the prelude to distribution. If large addresses are buying to later sell into public excitement. Third, liquidity is patchy, despite healthy daily volumes. The order book depth at crucial moving up price intervals is often shallow for memecoins, which magnifies slippage and makes sustained, orderly advances costly. A single large sell order, or a sudden withdrawal of market-making support, can produce outsized pullbacks. The liquidation map is a warning, where leverage is concentrated. Both rallies and collapses are more violent. Another subtle but important risk is the false fractal problem. Charts can visually resemble a prior breakout, but if the underlying market structure has shifted, for example, if the 2024 rally was driven by a one-off stream of institutional attention or by specific liquidity characteristics that no longer exist, the pattern will fail to repeat. The 2024 PEPE run was a particular confluence of factors: a novelty premium, nascent liquidity that allowed sharp percentage moves, and intense social momentum. In 2025, the market is different. More sophisticated players, more derivatives, and faster reflexive bots change the dynamics. A fractal is only useful if the behavioral drivers are comparable, and that's an empirical question that requires us to watch not just price, but flows. Are the new buyers sticky? Are they building positions to hold through volatility? Or are they momentum hunters who will exit quickly at the first sign of choppiness? On-chain metrics can help answer that, but they lag sentiment shifts and cannot predict a sudden external shock. So what does a practical path to 3x look like? And what contingencies derail it? A credible three-step bullish path would be: 1. PEPE holds the critical support band after the breakout, consolidating above the former resistance and converting sellers to buyers. 2. Continued retail accumulation is paired with at least one or to substantial whale moves or institutional lambs that reduce exchange float and create durable buy pressure. And 3. A sequence of positive catalysts, new exchange listings, high-profile social amplification, or a technical upgrade in the PEPE ecosystem drives fresh flows while liquidity remains supportive. If that sequence occurs, leveraged shorts above the current price would be further compressed in subsequent phases, creating feedback loops that can produce outsized percentage gains. By contrast, derailment scenarios include a rapid shift in macro conditions that drains risk capital, the appearance of a large distribution by previously quiet large holders, a major exchange or protocol incident that shakes confidence in memecoins, or simply failure to convert the breakout into higher time frame confirmations, weekly closes, expanding volume, falling exchange supply, which would invite profit-taking and a return to the accumulation range. The liquidation clusters make both scenarios realistic. Lean into them, and you can ride a strong rally. Ignore them, and the next stop-loss cascade can blow a hole through your thesis. Practical risk management matters more here than in most other corners of crypto. For momentum traders, tight risk controls and scaled entries are essential. Consider buying a base layer on the breakout, then adding on confirmations sustained close above the breakout with expanding spot volume and falling exchange balances. Use staggered sell targets and trailing stops because meme moves often melt gains quickly. For longer-term holders who believe in the community and narrative, dollar cost averaging into weakness reduces the pain of volatility and the risk of catching a falling knife. Hedging via options, where available, can be a prudent way to participate, with defined downside. For retail participants lacking sophisticated tools, position sizing and an exit plan are the simplest hedges. Importantly, watch the non-price signals, daily active addresses, exchange inflows, outflows, large wallet movements, derivatives open interest shifts. These will flip the probability of the 3x outcome one way or the other far more reliably than price action alone.